Welcome to the deep dive. Today, we're going to challenge one of investing's oldest ideas.
Buy low, sell high.
Yeah, we're flipping that. Our deep dive today is into something, well, quite different. The principle of buy high and sell even higher.
Okay, sounds intriguing. So what's the official term for this?
It's often called the principle of persistent strength, but most people know it as momentum investing.
Right, momentum. And our mission today.
We want to really break down why this strategy seems to work so often, how you can actually measure this strength, and, what it means for you when you're looking at the market.
This buy high, sell higher thing,
Yeah.
it feels almost wrong instinctively.
Yeah.
But you're saying it's not new, it has history?
Oh, absolutely.
Yeah.
Deep roots. You've got legendary traders like Jesse Livermore, who kind of intuitively felt these trends.
Mhm.
And then later, people like William J. O'Neill, at Investors Business Daily, he really codified it, used mountains of data. They saw patterns.
Pattern suggesting strength keeps going.
Exactly. Persistent strength. Now, that term relative strength, I know it causes a lot of confusion. Can you help us clear that up? Because getting this wrong can be costly, right?
It's hugely costly.
Yeah.
It's crucial. So there are two main things people mix up. First, what we're really focusing on, comparative relative strength. Think of it as the RS line on a chart.
Okay.
This directly compares a stock's price performance against something else, usually benchmark like the S&P 500.
So stock versus market.
Precisely. If that RS line is going up, your stock is beating the market. It's a leader. And think about this if the market tanks, but your stock only drops a little.
Its relative strength goes up.
Right, the RS line rises. That signals real underlying strength. Maybe big institutions are quietly buying.
Okay, so that's comparative RS. What's the other one people get confused with?
That's the relative strength index, the RSI.
Yeah.
Completely different beast. It's a momentum oscillator.
Oscillator. Okay.
Yeah, it measures the speed and change of a stock's own price movements just against itself, historically. It's internal, bounded 0 to 100.
So RS line is external stock versus market. RSI is internal stock versus self.
You got it. And that distinction is everything.
Why? Give us an example, like maybe with a famous stock.
Okay, think about NVIDIA back in 2023. Its RS line, the comparative one, was soaring. Screaming market leader.
Right, it was outperforming massively.
But its RSI, the internal oscillator, it was often way up in overbought territory, maybe even dipping while the stock price climbed. If you sold just because RSI looked too high,
Ouch! You'd have missed a huge run-up.
catastrophic mistake for many. The RS line correctly said, hold on, this thing is leading.
And O'Neill, you mentioned him. He quantified this leadership.
He did. With the IBD RS rating, it ranks every stock's price performance over the last 52 weeks, 1 to 99.
99 is best.
99 is the absolute top performer. And O'Neill's research found that the truly massive winners, historically they often showed an RS rating of 80 or higher before their biggest gain.
So it's a way to screen for these potential powerhouses.
Exactly, a concrete number.
Okay, so if it works, why does it work? It seems to defy logic sometimes. Is it just luck? Or something more fundamental?
Definitely not luck. And what's really compelling is that academics have studied this extensively. They call it the momentum factor anomaly.
Anomaly, like a market glitch.
Kind of. Even Nobel winners like Eugene Fama have researched it. They found it's a robust, persistent phenomenon across different markets, different assets. Some call it the premier anomaly. It just keeps showing up in the data.
Wow. And you mentioned institutions earlier. Are they the engine behind this, the smart money?
Largely, yes. Think about it. A big fund can't just dump billions into a stock instantly. They buy gradually.
Right, they'd move the price too much otherwise.
Exactly. So they accumulate methodically, maybe over weeks, months. And doing that leaves. Well, we called them footprints earlier.
Footprints on the chart. I like that. Can we actually see these footprints?
You can, once you know what to look for. Things like really tight price consolidation, the stock just stops going down like there's a floor under it.
Institutions absorbing the selling.
Precisely. Or you see volume dry up. During that tightness, sellers are gone, supply is absorbed. Then maybe you see sudden bursts higher on big volume, what some call pocket pivots.
Like surge of demand.
Yeah, strong institutional buying, overwhelming any selling. So that RS line, the comparative one, while it's an outcome of price, it acts as a leading indicator for you, signaling the smart money is placing bets.
Okay, this is making sense. So practically speaking, how do you use this? Is it just about picking stocks with high RS?
It's usually part of a top-down approach. First, you got to check the overall market weather. Is it a bull market? This strategy thrives then, ideally in a confirmed stage 2 uptrend.
Market first. Makes sense.
Then you look for the strongest sectors within that market. And then you drill down to find the leading stocks, the ones with the high relative strength within those hot sectors.
But nothing works forever. When might this strength signal let you down?
Good question. You need to watch for warning signs, like a bearish divergence. The stock price hits a new high, but the RS line doesn't follow.
Momentum is fading internally, even if the price ticks up.
Exactly. Or breakouts that fail, especially late in a bull run from messy, volatile price patterns. That often needs distribution, not accumulation.
And market crashes.
Oh yeah. During sharp market downturns, or especially at bear market bottoms, you can get momentum crashes where the beaten down value stocks suddenly rocket higher and the recent leaders get hit hard. Market context is key.
Which brings us to risk. Livermore, O'Neill, they must have hammered this point home.
Absolutely non-negotiable for both. Strict risk management. Use a stop loss. Always. Whether it's 7%, 8%, 10%, you must protect your capital. Cut losses quickly.
That's crucial advice. So wrapping this up for our listeners, the core idea here is that strength often begets more strength.
Right. It's a durable market pattern backed by history, research, institutional behavior. It's a whole system, really, not just one indicator.
So here's a thought to leave you with. How might understanding these hidden institutional footprints, these signs of strength on a chart, empower you?
Yeah, how could it help you spot potential market leaders before everyone else jumps in? And maybe align your own approach with where the big money seems to be flowing. Think about that.